Hello everyone. So welcome back. Now we're coming to the last part of the second module, Indian money market, its defects, measures and recent trends. So let us see here in this last part of the module, what are the various weaknesses in the Indian money market? Then what are the measures taken by RBI to keep control over them? Also, what are the new recent trends in the Indian money market? Are you ready? Come, let's move. So, first of all, the defects or weaknesses in the Indian money market. First is existence of unorganized money market. We have already discussed in the previous session that as the term specifies, unorganized money market is a market where you cannot find any sorts of guidelines, recommendations, rules, regulations, or anything. So it's all in the hands of the indigenous bankers and money lenders who create exorbitant rates of interest. So what happens is there is more of biases, personal biases and prejudices on the part of the indigenous bankers or the money lenders. Also, we can find that more exploitation of the consumers can also happen, or the investors can also happen. So SEBI really plays a vital role. Securities Exchange Board of India plays a vital role in authorizing certain persons, brokers, so that they would help people in the unorganized money market to be much organized. So this existence of, moreover, the existence of this unorganized money market can create a big problem in the coming future. The second one is non-coordination of organized and unorganized sector. We found that there is a lot of difference between the organized and the unorganized sector. This you can find that the limitations are more in case of the unorganized sector, though it is very though its history is moving towards past. So what's happening is that this unorganized sector is trying to be brought under the organized system by RBI. And if there is coordination, then it would give a better results. But if there is non-coordination, it can be a weakness too, hampering the entire stock market system. Next is multiplicity in the rates of interest. Rate of interest is always to be charged as one and uniform by SEBI. But if you find there is an unorganized money market sector, what happens is there can be a different monopoly over the pricing strategies of the. So what happens is the different interest rates will be really exploiting the consumers as such in the stock market. Next is the seasonal stringency of funds. We can find due to certain reasons, seasonally, there can be some difficulty for funds. For example, take the scenario of COVID recently. What's happening? We can find that the flow of funds is very less. Though the outflow is more, the inflow is very less because there are no better channels to pool the money into the account. So this can also lead to a difficulty in the Indian money market. Next is absence of well-organized banking system. We don't know properly what's going to happen. The banks, if the banks and the commercial banks and the various other regional rural banks and land development banks, all these banks, they don't play a vital role here, then what's going to happen? It will lead to, it can entirely hamper the creditworthiness of the firms. Then absence of movement of funds. As we told, the inflow and outflow, there is an outbreak. Then absence of specialized financial institutions. We have discussed the list of specialized institutions previously: LIC, GIC, UTI, then we have SFCs, then DFHI, different examples we have seen, IDBI. So what's happening is that if these are absent, then obviously we can find there will be some defects here and there. Absence of sufficient submarket meaning like bill market, commercial papers, commercial bill. Then we have certificate of deposits, promissory notes, treasury bills, and so on. All these are things very important, isn't it? So without them, what happens is we can find the money market getting collapsed very soon. Inadequacy of credit investment. We should have some money that is to meet the uncertain future. So if the credit investments made pooled in is inadequate, then obviously it can hamper the entire Indian money market system. Then we have inadequate banking facilities. Then we have inefficient and corrupt management. Sometimes we can find the management or the corporate can undergo to scandals and they can be corrupted, due to which the entire money market can be affected. Next is absence of bill market due to certain limitations. Now we know that there is a bill market, commercial papers, certificate of deposits, promissory notes, treasury bills. All these are the examples for bill market, right? So if the bill market is not there, what will happen? There are certain limitations for foregoing this particular aspect. One is the no uniformity in drawing bills in different parts of India. We have 29 states with the 7 union territories. So what happens is that 29 states with 7 union territories means what happens is we cannot predict what is going to happen. So different states would have different perspectives of doing things. Then cash transactions are preferred in business lines. Then lack of acceptance houses and discount houses that are instrumental in development of organized bill market. Most of the commercial transactions, they are done on cash basis. Indian banks, they prefer to invest funds in government securities rather than the bills of exchange to ensure the public confidence and liquidity too. Then higher stamp duty is also charged on the usance bills, discouraging the use of the bills. So usance bills are those bills which really are being used for a particular period of time. Okay, and you cannot, if you try to use these bills in between, you cannot change it also. So what happens is it might not be promoting the use of bill market. So these are the reasons that we are finding there is a decline in the trend for bills market in India. Next is the measures taken to overcome the defects. So what are the measures? The first one is the deregulation of interest rate. There are important interest rates in India like bank rate, medium-term lending rate, we see MLR, then PLR, that is called prime lending rate. Then we have bank deposit rate, call rate, then certificate of deposit rates, commercial paper rate, and so on. This deregulation got a major push after the economic liberalization, LPG, liberalization, privatization, and globalization of 1991. Chakravarti Committee was a strong proponent for this free and flexible rate interest rate system in order to promote investments, mobilize investments, savings, government financial stability and system. So RBI removed this upper ceiling of 16.5% and it was fixed as a minimum of 16% per annum too. So these rates were relaxed after the Narasimhan Committee report in 1991. The second one is the reforms in call and term money market. Such reforms were done to infuse or to promote more liquidity into the system and enable the price discovery. RBI undertook several steps to check the constraints and remove them systematically. It was in October 1998, the RBI announced that the NBFC, that is NBFI, that is non-banking financial institutions, should not participate in the call or term money market operations and should purely do the interbank operating segments and encourage the participants also to migrate to the collateralized segments to improve stability. Third is introduction of new money market instruments. RBI introduced many new money market instruments to diversify the market. These are now certain money market instruments we have already known, like example, certificate of deposits came in 1989 in India, commercial papers in 1990. All this was done in order to reduce the risk actually and increase the return. The fourth one is setting up the Discount and Finance House of India, DFHI. DFHI, that is, it was set up in 1988. So these years and objectives are very important. This can come in the exam too. So DFHI was set up in 1988 to promote liquidity and to develop the secondary market instruments. However, the maturities of existing instruments like commercial papers and certificate of deposits were shortened, gradually shortening. It is declining in order to encourage the wider participation. Likewise, ad hoc means immediate treasury bills were abolished in 1997 to stop the automatic monetization of fiscal deficits. Then the fifth one is introducing LAF, that is Liquidity Adjustment Facility. RBI introduced this particular facility in June 2000 in order to operate through fixed repo and reverse repo rates. See, if you compare the repo and reverse repo, that is, we can find repo is actually, it's 0.25% more than the reverse repo. So it should be like that. And this really helped the establishment of interest rate as a monetary instrument and greater flexibility to RBI to market needs and suitably adjusting the liquidity in the market. So this is called LAF. So this facility provided was 2000 June, and this is known as LAF, Liquidity Adjustment Facility. Repo and reverse repo rates were introduced in 1992 and 1996 respectively. So reverse repo in 1996 and repo in 1992. Please remember that. Now, before we go into this, we let us know something about the repo and reverse repo. See, repo and reverse repo means there is a difference between them. So repo rate, important question. Repo rate meaning is it is a benchmark interest rate at which money is lent to the commercial bank by the central bank for a short period of time against the collateral security you're making. Reverse repo is it's the interest rate offered by the RBI to the commercial banks on the deposits who park there, who try to invest more surplus funds with the RBI. Then repo rate, if you find, it's a rate at which the liquidity is injected into the economy. But in case of reverse repo, it's a rate at which the liquidity is absorbed into the company. So injected into the economy is nothing but a repo rate, and absorbed in the economy is known to be the reverse repo. It's just the reverse. So reverse repo rate should always be lesser than the repo rate. Please remember that. So repo rate is its main purpose is to fulfill the deficiency of the funds, and reverse repo is to manage the liquidity in the economy. Repo rate should be high always, and reverse repo should be comparatively less by 0.25%. It should be reduced value to repo. So reverse repo rate should be always lesser than the repo rate by 0.25%. Please remember that. Repo rate is used to control inflation, and reverse repo is used to control the money supply in the economy. Repo rate means full form is repurchase agreement. Reverse repo full form is reverse repurchase agreement. Repo rate, what impact does it have on the increase in the rate? That means it will make the commercial bank borrow less from the central bank, from RBI, due to high interest rate. But reverse repos, it encourages commercial banks to transfer more money to the central bank and earn interest. And what impact does it have in the for the decrease in the rate? If the repo rate tries to reduce, then it means that taking loans from RBI will become more cheaper for the banks. Yeah, people can take loan from RBI at a more cheaper rate. But if in case of the reverse repo, if it tries to reduce, banks will have to invest their money in better avenues than their depositings with RBI. So this is the general distinction between repo rate and reverse repo. Please remember, it's very important question. Continuing with the sixth measure taken by RBI to overcome the defects. The sixth one is the refinancing facility, or we call refinance by RBI. So this is a potential tool taken by RBI to meet any sorts of liquidity shortages and for a credit control method to various other important sensitive sectors. Sensitive sectors is nothing but like real estate and so on. Then we have the export credit refinancing facilities to the banks is also provided in Section 17, subsection 3 of the RBI Act 1934. This is mainly available to all the scheduled nationalized commercial banks in order to deal in the forex, that is foreign exchange activities, and extended export credit facilities. It also suggested narrowing of the priority sectors, realigning the focus to the small. It's mainly focusing towards the small farmers and low income target groups. The refinance rate is always linked to the bank rate. Please remember that. Next is, there are some other measures too, that is regulation of NBFC, non-banking financial companies. RBI amended this, but RBI Act was amended in 1997. Earlier, though RBI Act was passed in 1934, it was re-amended in the year 1997 in order to bring the NBFC, non-banking financial companies, under its regulatory framework. What is an NBFC? It's always a repeated important question. An NBFC is a company which is registered under the Indian Companies Act 1956, and it's involved in making loans and advances, various functions of NBFC, making loans and advances, acquisition of shares, stocks, bonds, securities issued by the government, and so on. They are similar to the banks, but are different from the latter because on one ground that they cannot accept the demand deposits and they cannot issue checks to. Then next is the next one is the eighth one is debt recovery. RBI set up the special recovery tribunals for any sorts of the grievances management law related to investments in money market. So this will be giving the legal assistance to the banks for the recovery of the dues. And the ninth one is some other measures are also there, like LIC, Life Insurance Corporation, General Insurance Corporation, Industrial Development Bank of India, and Unit Trust of India, all specified mutual funds. They were also permitted to operate both the lenders and the borrowers. Scheduled commercial banks and their subsidiaries were permitted to set up the MMF, that is MMF, that is nothing but money market mutual funds in 1991. And what is the benefit of this? This provides additional short-term revenue to the investors within the reach of the individuals and small bodies. RBI prepared a scheme in 1937 in order to integrate indigenous bankers with modern banking sector. Indigenous bankers should give up their non-banking business. They should maintain proper books of accounts and get them audited and inspected by RBI. They should also submit the statements regarding the financial position to RBI from time to time and get them published. The last but not the least is the recent trends in Indian money market. Now, what are the new developments, the recent developments in the Indian money market? So if you see, the first one is integration of organized and or unorganized money market. We found that it's a limitation in case of the Indian money market that there is no integration. Okay, no control over the unorganized money market. So what's happened is SEBI and RBI is taking various efforts to try to integrate organized and an organized and unorganized money market together. Then next is enlargement of call money market. Then we have establishment of DFHI, that is Discount Finance House of India, that is Finance House of India, that is in 1988. That's we have already seen that. Then we have establishment of STCI, that is Stock Trading Corporation of India in 1994. Then we have introduction of new instruments like treasury bills, repos, derivative, usance, promissory notes. Then we have collateralized borrowing and lending obligations. Then we have money market mutual funds. All these things have been really creating a turning point in the recent Indian money market. Setting up of credit rating agencies. We know it is actually being dealt in the coming modules. Credit rating agencies is nothing but it's trying to use to rank the quality of the assets of the company. So based on their performance, like there are three types of credit rating agencies in India. We have that is ICRA, then CARE, CRISIL, all this other. There are different promoters, banks are different promoters are there for these credit rating agencies. We'll be discussing about them in depth in the coming sessions. Then liquidity adjustment facility, just now we discussed. Introduction of interest rate swaps. Swaps are the financial instruments which are used in the derivatives market. It's a simultaneous transaction between the buyer and the seller based on the exchange of the foreign currency we have for the goods or the services which are being bought and sold. Then electronic dealing system, everything is based on the NEFT, that is National Electronic Funds Transfer, and RTGS, real-time gross settlements, and so on. And finally, we have strengthening of the payment system. Today we have the main issues that regarding the ethics, the cyber ethics, that will give importance for privacy, security, and so on. So this payment system, whatever we make, it has to be, though it is very quick and quick decision making is being done in this matter, there is a problem regarding the security and the payment. So this has to be considered, and for which the RBI is playing a vital role in looking into this, for that so that the entire payment system is strengthened and made more transparent. Okay, so these are the important things for today. And with this, we wind up the second module. Thank you.